Well, good afternoon, everyone. It is I don't know, 4 o'clock or so on Friday, the 30th of March, 2018. It's Jeff. Markets were closed today here, and I thought I would take a rare opportunity to publicly post an update about what the Greedometer algorithms are doing. This is a particularly opportune time to do that because there are some distinct similarities between what's been going on for the last little while and what happened in 2007. So what I'm going to do is I'm going to provide a lot of information here on this video. I'm going to go through it relatively quickly, but I'm going to show you some other examples on the website where you can find more videos and you can go through things at your own pace. All right, so a good many of you, I suspect, are going to be new to this, so there's going to be some education and some examples here, okay? I'm going to start with, let's see, there are two algorithms, the Greedometer algorithm, which is strategic and slow moving, and there's the mini Greedometer, which is somewhat tactical and faster moving, okay? What I'm going to do is I'm going to walk you through a time series of Greedometer readings that happened during the last big crash that everyone knows, 2007, 2009. Show you how to use, really briefly, that algorithm, how it was applied there. I'll go through the same thing, an example on the mini Greedometer, and then I'll show you where we are now, and we'll go from there. So this video is going to be a little bit longish. You can stop and rewind, and again, you can go to the website. I'll show you where and watch other videos, okay? All right, so in a nutshell, the Greedometer algorithm, its job is to provide a warning before the stock market crash, okay? The first implementation of the Greedometer algorithm, the first instantiation of it during a crash was 2000 to 2002, 2003. The second was this one here, 2007, 8, 9, okay? And we'll walk through some others as well. Here's, in a nutshell, really quickly how you use it, okay? If you pay attention to the stock market, you're watching the wrong thing. If you pay attention to the Greedometer, you're watching the right thing. Here's what I want you to take away, okay? As the stock market was setting new all-time highs and testing new all-time highs in July of 07, and then retesting in October of 07 on a weekly close basis. I think this was about 1.5% higher than this was. So for all intents and purposes, a retest of the same peak. In between, there's a 10% drop in the SPIX, S&P 500. So new all-time high, 10% drop, go back to retest it. Now, while that's happening, you have these elevated values in the Greedometer. Let's call it 7,000 RPM. Right? So we dropped from about 7,000 RPM to, well, under 5,000, so a 2,000-ish RPM drop, which is substantial, and then a lower peak here. This is substantially lower than this, and that's the telltale sign right there. That's how you use this algorithm in a nutshell. That's a classic example, so that when this was happening in October, you would have watched this drop and this bounce to a decidedly lower value. That was the telltale sign that this was basically a sucker rally, and this is the launch point for a crash. Of course, it was. So this is a slow-moving algorithm, and for the most part, that's all you can get out of it. This is a little bit noisy, and to get more out of more tactical use out of the algorithms, we'd switch to the tactical algorithm, the mini Greedometer algorithm. So stop it, rewind it, get used to this as you see fit. No, that's not where I want to go. I want to go to here. Okay, so this is the mini Greedometer algorithm, or somewhat tactical algorithm, a time series of its readings in red applied to the last big crash, right? 2007, 8, 9. You can stop and rewind, but in a nutshell, here's what you do. As the mini Greedometer values generate what I call a baseline and a top line, that provides a constraint for identifying where in time the S&P 500 will invert or reverse course. So this is basically a birth point, initiation of the sequence. This is your first baseline point, and this is your first top line point. When you have these three, you can basically begin to do, well, more than just portfolio management, but actually active market timing. So you can see, a great lineup of the red lines here showing the drops, showing the troughs, and the green line showing the peaks, okay, accurate to about a week or so, which is what this algorithm is. So you again, you knew that when October of '07 came around, you pretty much knew, yeah, this is this is a crash launch point. You also knew when Bear Stearns blew up in March of '08 that you were well into the sequence, you were well into the crash. There's another inflection point, back up we go. Okay, same thing. Now this is what's interesting, and you could look. There's another video in this, so you can stop and you can watch the other one. But this is a dynamic system. Price is not an input. Price is not an input to the Greedometer algorithms, and it is also not an input to the mini Greedometer algorithms. What you see here is a dynamic change. When something major happens from a central bank, when they institute something new and yummy that's significantly large, it'll have an impact on the crash. So what happened here was the Fed launched QE1 that prevented what would have otherwise been another drop in the SPIX. You see that drop here to 800? Yeah, that's nothing. Okay, it would have continued for another week and probably in time bottomed out in time the next week, probably in the 600s. Okay, the next week. But Fed announced QE1. So back up we go. What that did was that warped the sequence. So we pushed up the top line and we flattened the baseline a little bit. Things began to roll over. Things got tremendously ugly in March of '09. And with the SPIX bottoming intraday at 666 and the Dow dropping to what, the 6400s, that was the end of that crash. Now you can see from this, well, hey, hang on a second. We are nowhere near this projected baseline. That's right. And that's how we know the crash was going to continue for probably that week and the next week. And believe it or not, that 666 on the SPIX, well, that was really nowhere near where this thing was going to bottom out. The next week, it was probably going to drop to the at least 500s, if not 400s. Okay. So anyway, but what happened here, two things happened in March of '09. One, the FASB changed accounting rules for banks, making them instantly appear solvent, and they weren't, but made accounting rule change from mark to market to mark to model allowed them to appear solvent, and well, that made a massive change in the whole story. The second thing is the Fed dramatically here increased the size of its QE1 program. So we go back to the top line and then we blow out. Okay, I'm going to visit this chart. Again, there's another video. You can stop it, rewind it. But if you're wondering, hey, how long is it going to be until the next crash? Glad you asked. Well, coming into this crash, the amount of time between the end of the 2000 to 2003 crash and the start, or the birth point, this point here, was 180 odd weeks. Okay, now when this crash was stopped, which is this point here, we set the timer again and go, well, gee, how long is it going to be until the greedometers begin to warn of another crash? Well, there would be about, what, 48 or so, 45, 48 weeks, the spread between the truncation or the end of this sequence and the warning before the 2010 flash crash. There'd be that many weeks. All right, so before we go there, now I'm going to go to now that you know roughly something about and how to use the greedometer sequence and the mini greedometer sequence, I'm going to show you what are they doing now. Well, this is what the greedometer sequence looks like right now. Okay, exceptionally elevated readings. This is this week here. Exceptionally elevated readings. Things are rolling over. I would expect this to basically bottom out in the next few weeks and then go back up. Why do I expect that? Because this is what things look like. So July of '07, we had basically a 2,000 RPM or so drop back up to October. So I would have expected, without all of these threats from central banks that happened over the last month, I would have expected a 2,000 RPM drop from there-ish to about, here-ish, bottom out and then come back up. Pardon me. But there was a full barrage of threats from Bullard, from Dudley, and from Powell over the last month or so, which basically caused this choppiness and stopped a larger drop. So look at how smooth, see how smooth that is? Nice straight drop, right? Well, there were no central banks intruding every week or every two in the middle to say, hey, we're going to spike the punch bowl or whatever and stop the crash. Well, that's exactly what we haven't had that. We've had nothing but central banks intruding to sort of stop a crash. That being said, so that's why this is sort of ugly and wiggly here as opposed to straight and smooth like that. Okay? Okay. So that's what the greedometer sequence looks like right now. And with this as sort of your basis, or this is your training ground. Now, what the mini greedometer sequence is looking like is this. Now, this is kind of busy and kind of noisy, so what I'm going to do, I'm going to bring this one up. This is your training ground, okay? You got a birth point, you got your first baseline point, you got your first top line point. Your first top line point, if you extend the top line, it would sort of go just over these peak readings before the first baseline point. So, that's your training ground. Apply it to this. There's the birth point where the tax cuts announced truncated the previous sequence and immediately gave birth to this sequence. This is my estimated mini greedometer baseline, and I will talk about that briefly. You can see how wildly elevated this was, but anyway, that's this week here, and that's last week. So you might say, well, going through this, you might have thought, hey, that's going to be, maybe this is going to be the first baseline point. Well, no, I was anticipating that's nowhere near low enough. Why? Because this is the pace, this is the baseline from the mini greedometer sequence of 2007-8-9. This is the pace of collapse. So it took 17 months to lose 57% in the SPICs, and again, it would have lost a lot more had it not been stopped here. But 17 months, 57% drop. That's with a pace or a slope of a baseline being this slow or this shallow. I expect the baseline so far to be about this steepness. The reason why is I take an average of the past, all of the mini greedometer baselines that began to form over the last 5 years or so, and applied a slight flattening to it because we're working in an environment here that has a tax cut, and none of the other ones did. And well, tax cuts are yummy, so that makes things less ugly. So my estimate is at this point in time is the baseline will be about this steep, about this fast. So that should not and cannot have been, we know now, was not a first baseline point. We also know that last week's mini greedometer value here is also not a first baseline point. Two things. A, we know it's not a first baseline point because the PBOC intervened that week near the end of the week and intervened across every equity market, every index market, the Forex market, the Treasury market, everything, and slowed for about half a day or so a drop. So had that not happened, the SPICs would have absolutely closed instead of the high 2500s, probably the low 2500s to probably low 2500s, and we would have seen a mini greedometer value for that week around here, and I would bet that would be our first baseline point. But it was prohibited from happening from our friends at the PBOC, the Bank of China. Okay, so but notice that value is substantially lower than here. So this is the pace of the collapse of 2007-9. This is noticeably, this would generate a baseline, like that, right? Noticeably faster than that. And again, this value that we got for that week would have been somewhere around there had the PBOC not intervened. So this is a pretty good estimate of what we've got so far. What this means is this bakes in everything that's known right now, which is 4 Fed rate hikes this year, and every other major central bank sitting on their hands and threatening to do less QE, but do more QE if they have to, something like that. That's what this is. That's what's baked in with this. So you can see other things on this chart. You can see, well, I'm anticipating that someone at the Fed, probably Mr. Dudley, is going, someone at the Fed, either Powell or Dudley or Bullard likely, is going to threaten something very yummy. Let's see, Dudley exits in June, he retires in June. So May, June, someone is going to threaten something very yummy like no more rate hikes, or they'll threaten another QE program, something pretty epic. And I suspect that won't truncate or stop this crash. I suspect it'll basically flatten this baseline from here-ish to about here-ish. Now, this is a suspicion. What we'll see over the next few months is we'll see how this plays out. We'll see no Fed rate hike in June, which will follow through on probably whatever gets threatened here. Probably again another threat this summer, and no rate hike again. So we go from 4 rate hikes to, well, maybe 3 or 2 or none, probably 3 or 2 to like none, and this would bake in this model would bake in no more rate hikes, and God knows what's going to stop it, but whatever. Approach the slowness of, I said that, the slowness of the crash of 2007, 8, 9. So this is a mechanism, again, to sort of capture what central banks are doing and the environment that we're living in. So let me get this one out of the way. Quickly give you some other examples, okay? This is what the Greedometer sequence looked like during 2010 when there was a flash crash. And coming into this, I remember I talked about, well, how much time, how much of a lead up was there heading into the flash crash? Well, there was that many weeks to that point. And this is a beautiful exponential decay curve, right? So don't let anybody tell you stock markets are crashing on a random basis. This chart tells you completely otherwise, okay? Anyway, I'll come back to it. But this is what the Greedometer sequence looked like as a result of that flash crash. Massive, massive drop in Greedometer values. And of course, that crash was stopped by the Fed threatening and then launching outright QE2. All right, what did the mini Greedometer look like? Timeline sequence. The baseline begins to get formed, very well formed, right? Very well formed. A nice sucker rally going on here, and we arrive at the week immediately before the flash crash. Where you guys remember that, right? May 6, 2010, the Dow was dropping 100 points a minute. Fun day. I was at my computer watching it. Profitable day. But anyway, look at this epic drop in mini Greedometer values. And you might say, hey, how come it didn't drop to the baseline here? Well, this is a active system. This system captures what central banks say and what they do. Well, here the Fed began leaking, and not just leaking, but outright making some overt comments that they'll probably do something new and yummy sometime soon. So what would you expect? Well, you would expect to not make it all the way to the baseline. And had they not done this, you probably would have seen another 10-ish% drop in the SPIX in the next week or two to about this point. But they did, though that prevented the baseline from being seen. Back to the top line we go, spend some time along there, and then boom, Jackson Hole, they announced QE2. On with the party. How long do we have to wait? I'm glad you asked. We look at our chart of this, and we see, well, how much time was there between basically the 2010 flash crash, and how long would we have to wait until things would get ugly in 2011? Well, that many weeks. So what's that, about 25 weeks plus or minus, 24 weeks? Let's look at that. All right, this is a great example. So this is what happened. This is the Greedometer sequence in 2011. So we get this nice wiggly high values, right? We get a 10% drop in the SPIX. We get this big 2000-ish or what, 1500 RPM drop in the Greedometer to a decidedly lower value. You've seen enough now. You know what this means. This is a crash launch point. And that's why I ran a quarter-page ad in the Wall Street Journal in early July saying there's a stock market crash is going to initiate. Obviously it did, because it dropped 20% over the next few weeks or so. And it had to be stopped. By, we have at this point more threats by the Fed and the European Central Bank. We follow up with Operation Twist and more yumminess. ECB announced Eltro 1 and Eltro 2, so that broke that sequence. So you might say, look, we know how to use this system. You've seen several examples now. You know what this means. And even better, let's look at the mini Greedometer sequence, what it was doing in 2011. Boom, right? Look at this baseline. Beautifully formed, beautifully formed. We get that drop. We get the sucker rally. Back to the top line we go, right? And then we see, this is why I ran that ad. It's like, was there a chance it was going to be wrong? No, it's never been wrong. 19 years of data, this system has never been wrong. It basically gets warped and impacted by central banks. There you have it. But that's what things look like. You can stop this. You can look for yourself at the alignments of the green and the red for the peaks and the troughs. This is what happened. Again, so this was stopped by Operation Twist and Eltro. How much time would there be until the next stock market crash? Well, we go, let's see, that much time between those. So we get to here. That's the G4 and G5, Greedometer 4, Greedometer 5 sequence. And we get less and less and less until we basically get to 0. There are 0 weeks between these sequences, this sequence, and between the 11 and 12. And we are in the 12th sequence now. So that's several examples of the greedometer sequence and mini greedometer sequence, and importantly, the relationship between central banks stopping all of those crashes and how their actions are getting less and less bang for their buck, buying less and less time till we get down to zero, which is where we've been for the last 2 or 3 years. Something gets stopped, immediately another sequence is launched. You might say, well, you know what? Let me open this up. There are lots. This is greedometer.com, okay? And for those of you that are new, this is an interactive greedometer tool. You can change the VIX, you can change equity WLI, which is a bit of a proxy for GDP. You can adjust the adjusted PE on the SPIX. You can adjust profit margin in real time. All of these, you can see the change in risk as captured by the greedometer algorithm. I am talking fast because there is a lot of ground. I want you to go here and I want to look at these greedometer videos, okay? So there's a great explanation of how you use this system. This chart you've seen before. I've referenced it. This is a video for the 2007-8-9 crash. This is a video for years later. This is, I think, 2013, 2014, I think, 2015, and great examples in here. This one has a great example of what happens if, say, the Bundesbank or the ECB announce some yumminess. What does that do? Gets captured right here. What happens if, let me see, this is a great one. What happens if the Fed announces a QE taper? Well, that's a dynamic system. It changes it here. And when the Fed backs away, you know, this is an awesome video. Watch this one for sure because it shows you how the system changes as the Fed does something bad and something good in terms of risk assets. Another fantastic video showing the system worked by all sorts of actions by central banks, sort of central bankers gone wild, if you will. All right, so you guys can go there. You can watch those videos. Great training ground. For those of you that have an interest in economics and really the big picture, and for those of you that have been following me for years, I've been talking about this year, so you can probably stop it now. You know this. Velocity of money. GDP is there's an accounting truism which basically says GDP is the amount of money or money stock or M2 money supply times its velocity. So, you know, things, basically the velocity of money peaked, was awesome in the 90s, peaked in the mid to late 90s, and has been basically in secular decline ever since. So velocity has been in secular decline since the late 90s. It's really, really hard to have substantial growth in secular growth in GDP. In fact, it's impossible, okay? So unless you're pumping an immense amount of money into the system, and they have been, because $20 trillion or so, 20-something trillion dollars has been pumped into the system by these central banks to stop it from collapsing, to stop the party from ending, okay? All right, so we talked about that, M2 money supply, and one more thing. There we go. All right, so when my data began in January of 1999, so I've got over 19 years of data now, and over 10 years that I've been using it. When this began, what this is in blue, this is the assets of the banking system in the US, and in red is real GDP, okay? So what I'm showing here with these percentages, that's the size of the banking system measured by its assets relative to the size of the economy, or GDP. So back in 91, the size of the banking system was, when the recession happened, at that point in time, the banking system was 36% the size of the economy. Fast forward to here, it was 49% the size of the economy. Fast forward to 2007, December of 2007, when that recession initiated, the banking system was 74% the size of the economy, noticeably more than this. So this crash was noticeably faster than this one, okay? And a good reason why that was is because the banking system was decidedly larger than it was in 2001. Fast forward to now, well, congratulations. You now have an economy which is the same size as its banking system. So given what we saw in terms of the speed of the stock market collapse in 2007-9 versus what we saw in 2000, 2003, what would you think would happen the next time we hit a recession? Yeah, okay? What you should expect is when the next recession hits, and we're flirting with the longest amount of time that we've gone without a recession, when that happens, there's so much risk in the system that, by virtue of the banks representing the size of the economy now, it doesn't take a lot to have a very pronounced, dramatic, bad impact on the economy. So what else can I tell you? I've talked about several examples. I've shown you the website, more videos, more examples. I've talked about this, and again, all these this is a very important chart, right? This chart shows you the relationship between all of these crashes, all of them being stopped by central banks, and the cost being this. And of course, right now, every central bank trying desperately to say things are awesome. That's why we're going to stop and reduce our QE programs, because they're trying to stop this because it basically just adds risk to the system. All right, that's a long video. This video should be of interest to you if you A, manage your own money, B, if you're an advisor, and I've got several, at this point several, I used to have many advisors that were managing people's money, more from Merrill Lynch than anywhere else, interestingly enough. But anyway, if you're an advisor, if you're a pension fund manager, if you're a hedge fund manager, if you're a banker, if you're managing risk at any of those institutions, and if you are a central banker or any sort of finance or banking regulatory authority, you should probably pay attention to what this video is telling you and get in contact with me.